Long before balance sheets and shareholder meetings, business was a social institution. Production was embedded in community reputation and ritual. In medieval Europe, the guild was not merely an economic unit. It was a governing body, a training system, a welfare provider, and a gatekeeper of quality. To belong to a guild was to belong to an order that regulated who could produce how they could produce, and at what price. Commerce was orderly because it was constrained. Guilds emerged to solve a problem that markets alone could not trust in a world without standardized enforcement. Crafts required skill verification. Consumers required assurance. Apprentices required protection from exploitation. Guilds supplied all three. They trained workers through long apprenticeships, enforced standards through inspection, and punished deviation through exclusion. Profit mattered, but stability mattered more. This stability came at a cost. Guilds resisted innovation that threatened established members. Entry barriers were high, prices were rigid, competition was limited by design. What guilds preserved was not efficiency, but predictability. In a pre-industrial economy, where shocks could be fatal, predictability was survival. As trade expanded beyond city walls, the limitations of guilds became apparent. Long-distance commerce required capital pooling on a scale no single master could provide. Risk needed to be spread beyond households. Partnerships emerged as transitional forms, temporary alliances formed for specific ventures. They allowed capital aggregation without permanent surrender of control. When ventures ended, partnerships dissolved. Risk was bounded in time. The real rupture came with the joint stock company. Joint stock corporations represented a radical departure from earlier structures. Ownership was separated from management. Capital was divided into shares that could be transferred without dissolving the enterprise. This innovation did not merely change how businesses raised money, it changed how society understood risk responsibility and failure. Losses became limited. Failure became survivable. The early joint stock companies were not neutral market entities. They were political instruments, chartered by states endowed with monopolies and backed by force companies like the Dutch East India Company and the British East India Company fused commerce with sovereignty. They raised armies, governed territories, and reshaped global trade. The corporation became an extension of the state power, privatized for imperial ends. This fusion left a lasting imprint. Corporations inherited privileges once reserved for governments, legal personhood, perpetual existence, and limited liability. These features unlocked unprecedented capital formation. They also insulated owners from the full consequences of their actions. The balance between innovation and accountability tilted. The Industrial Revolution accelerated this shift. Factories demanded fixed capital at scale. Railroads required financing beyond local elites. Stock markets expanded to channel savings into enterprise. The corporation became the dominant business form because it could absorb risk, mobilize capital, and persist beyond individual lifespans. With scale came complexity. Ownership dispersed. Managers gained autonomy. Agency problems emerged. Shareholders sought returns. Managers sought growth and control. New governance mechanisms followed boards, audits, disclosure rules, attempts to restore trust at distance. Business structure evolved in response to its own contradictions. The 19th century normalized the corporation. Limited liability spread from exceptional privilege to standard feature. Bankruptcy law softened failure. Innovation accelerated. But so did concentration. Trusts and monopolies formed. Markets tilted toward giants. The same structure that enabled growth enabled dominance. Society responded unevenly. Antitrust laws sought to restrain excess. Labor movements challenged corporate power. Regulation expanded to contain systemic risk. Yet the corporate form endured because it solved a central problem. No alternative could match how to coordinate vast resources across time and geography. The 20th century institutionalized the corporation further. Managerial capitalism replaced owner-led firms. Professional executives ran enterprises whose shareholders they barely knew. Corporations became social actors, employers, innovators, political influencers. Their decisions shaped communities and nations. Globalization extended the model across borders. Multinational corporations arbitraged labor regulation and taxation. Supply chains fragmented. Legal accountability lagged economic reach. The corporation became stateless in operation, national in law, and global in consequence. Throughout this evolution, one theme persisted: business structures reflect the balance of power in society. Guilds thrived when community control mattered most. Corporations rose when capital mobility mattered more. Each structure solved a problem and created another. Today's debates over corporate responsibility, stakeholder capitalism, and platform monopolies echo medieval arguments about guild privilege and public obligation. The forms have changed. The tensions have not. Seen across centuries, the evolution from guilds to corporations is not a story of progress alone. It is a story of trade-offs between stability and innovation control, and scale accountability and efficiency. Business structures are technologies of power. They determine who decides who benefits and who bears risk. The unresolved question is not whether corporations will persist, but how they will be constrained in an era where their reach exceeds traditional governance. History suggests that when business structures outgrow the institutions meant to oversee them, crisis follows and reform arrives only after pressure becomes unbearable. A pattern visible from the collapse of guild monopolies to the regulation of industrial trusts, and one that raises the question of whether the next evolution in business organization will emerge gradually through reform or abruptly through disruption, a disruption that would once again force society to rethink how economic activity is organized, who it serves, and what obligations accompany scale and permanence, a reckoning that forced society to renegotiate the boundaries between private enterprise and public responsibility. Because once corporations achieved permanence and scale, the question of who controls them could no longer be ignored. The second half of this story is therefore not about invention, but about restraint. As corporations grew larger and more influential, they stopped being merely economic actors and became political facts. Their decisions shaped labor markets, urban development, technological progress, and even foreign policy. Governments that once created corporations to serve public goals now found themselves reacting to corporate power they could no longer easily direct. The early 20th century marked the first great reckoning. Industrial giants, railroads, oil trusts, steel empires had grown so dominant that competition itself was threatened. Markets no longer disciplined firms. Firms disciplined markets. Antitrust laws emerged as society's attempt to reassert boundaries. The goal was not to destroy corporations, but to remind them that scale required constraint. Power without limits, history had already shown, corrodes legitimacy. Yet regulation never fully reversed the corporate trajectory. Instead, it reshaped it. Firms adapted through legal structure diversification and geographic expansion. Conglomerates emerged. Multinationals stretched across borders. The corporation learned to live with rules by learning how to navigate them. Complexity became both shield and strategy. After World War II, the relationship between corporations and society entered a period of uneasy balance. Large firms offered stable employment, rising wages, and predictable growth. In return, they accepted regulation, taxation, and social obligation. This was managerial capitalism at its peak, a system in which corporations were powerful but domesticated by institutions and norms. That balance did not last. From the late 20th century, onward globalization and financialization altered incentives once again. Shareholder value replaced stakeholder stability. Capital became mobile. Labor did not. Corporations optimized for efficiency, not loyalty. Supply chains fragmented. Legal responsibility remained national while operations became global. The corporate form proved remarkably adaptable, but social oversight lagged behind. Once again, structure solved one problem and created another. Corporations delivered innovation and scale, but diluted accountability. When harm occurred, responsibility dispersed across subsidiaries, contractors, and jurisdictions. The very permanence that once stabilized enterprise now insulated it from consequence. Today's debates about platform monopolies, data ownership, environmental damage, and worker precarity are modern echoes of medieval complaints against guild privilege. The language has changed. The core tension has not. Societies continue to struggle with the same question: how to harness organized economic power without being dominated by it. History offers no final structure, only recurring adjustment. Guilds fell when they constrained progress too tightly. Corporations rose because they enabled expansion. They will persist only as long as societies believe their benefits outweigh their costs. When that belief erodes, reform follows, sometimes gradually, sometimes violently. The evolution from guilds to corporations teaches a sobering lesson. Business structures are not neutral containers for activity. They are architectures of power. They decide whose voices matter, whose risks are absorbed, and whose losses are tolerated. Changing them changes the economy itself. If this story changed how you think about corporations, power, or responsibility, share what resonated with you. And if you want to continue exploring how the hidden structures of finance shape the visible world we live in, follow the channel and stay with this journey, because every economy is built not just on markets, but on the institutions that decide who may enter them, how they may grow, and when they must be held to account.